Welcome everyone to Vested Interest. This is Shane back again for another stock pick of the day video. It is October 26th, Thursday. This will be the last one of the week. We don't do these on Friday. We are going to take a look at Whirlpool today. This is one out of the, it's a kind of a slash between consumer discretionary and industrials. It really falls in the industrial sector, but it is a consumer discretionary item as well. Let's jump into the video. So if you want to know more about this company, check them out at www.whirlpool.com. That's www.whirlpool.com. That is their homepage where I pulled this information from. Whirlpool Corporation started in 1911 as a small company in Benton Harbor, Michigan. This is my home state here where I live in Michigan. For more than 100 years, its flagship brand has driven innovations from introducing the very first automatic washing machine in 1948 to winning more than 20 CES Innovation Awards. We're proud of the American heritage and ingenuity that drive our continued pursuit of purposeful innovation. And they still, provide that same service today. They are providing, washers and dryers, refrigerators, ranges, cooktops, dishwashers, microwaves, oven hoods. So right in that wheelhouse, if you're looking for an appliance for your house, you may look for a Whirlpool brand. They have more than just Whirlpool. Whirlpool, Armana, I think is another one. They have a couple different brands under their umbrella. Let's keep on rolling here. And the reason we are taking a look at them, down 15.83%, huge drop on the day. This is a massive drop. We are talking about Whirlpool Corporation, ticker WHR, again out of the industrial sector. Closed out the day at $105.73. I actually owned this one last year, but I started looking at the metrics there towards the end of last year, and it really was getting bad, so I sold it. I believe either late last year or first part of this year, out of my portfolio. I did not think the metrics matched up with what my investing criteria should look like. So let's see if they've gotten any better or if they've gotten worse, which is what this indicates to me here. They have a 52-week range as low as $104.50, as high as $160.74. So they are right up against their 52-week low. Average volume of 614,000. Today's was 4.8 million. Huge sell-off. Just like riding a slide right down throughout the course of the day. A bit of a bump there around, looks like about 10:30, 11 o'clock. But overall, a sell-off from start to finish. Market cap of 5.815 billion. Beta not applicable. So that's not good. I mean, you're going to see a lot of the numbers they don't even show. They're so bad they don't even show them. Price to earnings ratio, not applicable. So that means it's in the negative. Earnings per share in the negative, negative $27.89. Just bad numbers all the way around. I would say it's a very volatile right now. Earnings date, October 26th, which was today. So I'm assuming they missed either their earnings per share estimates, their revenue estimates, or both, or their future, or all of them. Maybe their future outlook is on the decline as well. But overall, not good numbers so far. Forward dividend is $7 per year annually, so divide by 4. We'll see that here in a little bit. Dividend yield of 5.57%. I don't think this is sustainable. We'll see that here in a minute why I say that. But nice dividend yield if they were able to keep that 5.57%. That would be nice, but I think this is definitely in threat of being cut here. Ex-dividend date, November 16th. So if you were to buy them now, you would not be in line for the next dividend payout. 1-year target estimate of $128.90. I don't know that I buy that, but they do see it coming back up over the next year, at least according to Yahoo Finance. Not affiliated with Yahoo Finance, just one of the sources I like to go to for information. Now, I like to go into statistics. I'm going to look for dividend yield theory here, as well as a couple other items we'll talk about. But to find dividend yield theory, we go down to dividends and splits. We look at their 5-year dividend yield average, 3.55%. We compare it to its current 5.57, or over here where it says forward annual dividend yield, 5.57. And since it is higher, that speaks to some potential overvaluation on this one. I don't buy it, and I don't buy it because the numbers are all so bad. So this is one time where I would not take dividend yield theory as the standard. I would say, yes, the dividend yield is much higher than their 5-year average, but the dividend yield is much higher because they've seen a significant decrease in their stock price, and they have seen a significant decrease in their stock price because they are having trouble, right? Their metrics are not good. Their numbers are not good, and we're going to see that trend continue here as we go through the video. Payout ratio is elevated, 103.91%. That's why I say they are definitely in danger of a dividend cut, and that's one of the reasons when I was looking at them late last year, another reason I decided to sell out of them, because it was elevated then too. So you can see that this company, and especially if we're going into recessionary times, people are not going to look to buy new stoves, to look to buy new washers and dryers, to buy that sort of equipment, a dishwasher. They'll wash dishes by hands if they have to. Rather than going to buy a new appliance, they will forego that. You can go to, rather than buying a new washer and dryer, you can go down to the store and wash and dry your clothes at one of the places in your local town or municipality that has a place to do that. You don't necessarily have to have one in your house, right? So these are the type of items people forego buying if we have a recession, which looks like we are already in one. If not already in one, we're definitely entering in one soon. Again, elevated payout ratio, not good, 103.91%. That leads me to believe they're going to cut the dividend if that continues. I don't see that not continuing based on the numbers. But let's keep going. Financials, you want to get in here. A lot of good information. You're going to look at their balance sheet, their income statement, assets over revenue. Are they paying down debt? Are they taking on more debt? What do their margins look like? A lot of good information in there. You want to be looking at that if you're interested in investing in a company. For this, we're going to look at free cash flow. We want growing free cash flow over time because that's what dividends are paid out of. 2019, $698 million. 2020 up to just over $1 billion. 2021, big jump up to $1.6 billion. 2021 was a good year. They not only had a big jump up in free cash flow, they also bought back a significant chunk of shares here. But 2022 dropped back down into $820 million, even though they were still buying back a bunch of shares, and currently to date $184 million. So it looks like a big decrease from 2022 to 2023 in free cash flow. It doesn't look like they've repurchased any shares either. So overall, from 2019 to date, decreasing free cash flow. They had a couple years of increasing free cash flow, but now it looks like it is decreasing, so that is not good. Again, you can see they're repurchasing some shares here back in 2019. Not a lot. 2020 about the same, a little less actually. 2021, big jump up in the repurchase of shares, little drop in 2022. So I do like that they're repurchasing the shares, especially if the price is cheap. But their free cash flow overall, I would say, is not increasing. Now, I always recommend more than one source. Another one that I like is stockanalysis.com. Make sure you're looking at more than one source. You can pick any two or three that you like. Just make sure you're looking at more than one source so that you can make sure the information you are getting is accurate and up to date. As you can see here, the last time they updated this information from stockanalysis.com was July 26th, earlier this year. So this is not the most up-to-date information. But even back in July, they were calling this a consensus hold. According to the 7 stock analysts that looked at it, I would actually say it's a sell. To me, this one would be a sell. That's why I sold out of it. It's not one that I hold in my portfolio anymore. I just do not like the numbers. Let's continue to look at the numbers here. They have a low estimate of $119. That would be a 12.55% increase from where it currently sits. I think it should be even lower than that. I think they're going to drop below $100 in my opinion. Average estimate of $142.43. That would be a 34.71% increase. And if it happened to hit their high of $160, which I don't see happening unless things drastically turn around, that would be a 51.33% increase in the stock price. All the while, you could collect that 5.3% dividend yield that we saw on the previous slide. That is if, or 5.7%, whatever it was. That is if they maintain the dividend over the long term. Now, I like to get into the statistics here and look at return on equity and return on invested capital to see how efficiently the company is reinvesting its money. And this one is not doing very well. Return on invested capital, negative 81.59%. That's terrible. They're burning money. You might as well just rip it up or throw it in the oven, set it on fire. This is not good. Return on invested capital is so bad they don't even list it, right? Earnings, and I usually like 10% or better for those. So not very good numbers at all. Earnings per share growth is not listed. I do not think that they probably expect earnings per share growth to grow. So again, so many negative numbers on here and some not even listed that they're so bad. This is one, I don't say it very often, just stay away from this company. If you are even thinking about investing in Whirlpool, give it a couple more quarters. Maybe throw it on the watch list. It's not even on my watch list right now. The numbers look so bad. I just am not interested in this company at all right now. I wouldn't invest in this company if you gave me money to invest in this company. I would invest in many, many, many of the other opportunities that are out there right now. But let's keep going and finish the video. At least get this one out there. Payout ratio we saw was over 100%. They don't even list it here. It's so bad. No dividend growth. As you can see here, they haven't raised it in a while. But let's look at 2020. They were at $1.25. Raised it up in 2021 to $1.40 in May. Raised it up again May 19th. Or I'm sorry, February they raised it up. So May in 2021 they raised it up. And then February 2022, they raised it up to $1.75. They have not raised it since February 24th of 2022. And they shouldn't be raising it. As a matter of fact, they should be cutting it if they were doing anything with it. So no growth in the dividend. Terrible metrics overall. Free cash flow is not growing. Earnings per share is in the negative. Price to earnings ratio is in the negative. Return on invested capital is in the negative. Return on equity is in the negative. I mean, it's just negative, 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 negative. And that's how I feel about this company. Stay away from this one. This is the vested interest stock screen. This is how I look at a company on a high level to see if I'm interested in adding it to my portfolio. If it meets the metrics, 5 of 8. If it's a financial company, 6 of 9. Price to books thrown in for banks. Then I'll throw it on my watch list, do a deeper dive, get into the financials of the company, do a discounted cash flow analysis on it, and then potentially add it to my portfolio or continue to adding to it if it is my portfolio. And if it doesn't meet these metrics and it's in my portfolio, it might be a good reason to sell. Just like Whirlpool, I sold because it no longer met the metrics that I had set up for my portfolio. So don't be afraid to get out of a position. If you get nothing else out of this video, don't be afraid to get out of a position that no longer meets your investing criteria. It happens to all of us. It's part of investing. Don't hold something just to hold it because you feel like, oh, I'm a long-term investor. I have to buy and hold. You don't have to buy and hold everything. If it no longer meets your criteria, it is a good reason to get out of the company and perfectly acceptable to do so. Well, that is it for this one. Let me know what you think of Whirlpool. If it is in your portfolio, I'm not trying to rip on you as a Whirlpool investor. Again, I grew up in, well, I was born in Wisconsin, but I grew up in Michigan, and I am a big supporter of local companies. Whirlpool being a Michigan company, I really want to invest in this company. The metrics just tell me I should avoid it right now. Maybe sometime in the future, whenever they get their act together, it will be one that I look at again and want to put in my portfolio. But for now, I am avoiding it. You do what you need to do for yourself, but I would recommend staying away from Whirlpool right now. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Hit that subscribe button down below and join us on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors so we can share our experiences, share stocks like this that we may be investing in or ones that we should be staying away from. That is the idea behind this channel. And hit that notification bell so you're notified whenever we put out any new content. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Whirlpool you'd like me to do a stock pick of the day video on, go ahead and drop it down below and I'll work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk against money and never risk. Any amount not comfortable losing them. Always do your own research, invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.